Hey guys, hope you're doing amazing. TJ Atkinson in the building, your finance coach, teaching you how to level up in your finances. In this specific video, we're going to be talking about how to determine what strategy you're going to use for your stocks and shares investment. And if you get some value from this video, make sure you like, comment and subscribe. It really helps in terms of the algorithm to put this video in front of more people just like you. So today we're going to talk about how to determine or how to develop your strategy for your stocks and share investment portfolio. In the previous video, we spoke about the 7 different types of things that you've got to consider before you get into the stock market. And one of them, the first one, was developing a strategy. So I should have spent more time actually talking about it, but that video was really long and quite informative. Make sure you check it out. Developing a strategy for your investment portfolio. Now, there are a number of things that you've got to consider. So when I talk about strategy, it all starts by reverse engineering what you actually want from your money. That's where you've got to start from. You say, hey, I want to make a heck load of money. I want some risk in my life. I don't want any risk in my life. This is what I want from my money. And you reverse engineer it and you work your way backwards. And that helps you to determine what types of stocks or what types of companies you are going to invest in. In this video, I'm going to talk to you about the 5 different types of strategies that you can pursue to help you get started. One of the main types of stocks that you can actually invest in is what we call income stocks. Income stocks are probably what you might know as dividend paying stocks. And a dividend essentially is you get some cash back essentially for investing in a company, in a nutshell. If the company does really well, the board of directors sit down and they say, hey, let's reward our investors by paying them a dividend, a small fee for investing with us. Now, this is an incredible opportunity for any person that wants to double down on their portfolio. What a lot of smart investors do is when they get paid a dividend, they reinvest that dividend, and that forms the basis for compounding. Essentially, if you had £100 and you get paid £10, you can reinvest that £10 as opposed to taking it out. Alternatively, if you needed income, if you've got a good high-performing portfolio that pays a dividend, you can take your dividend and spend your dividend on your living cost and living expenses. They're typically stocks with low volatility, quite safe. Truth is, in reality, there aren't so many companies that pay a dividend. So you've got to determine, do I want an investment or do I want a company that's relatively safe and will pay me a steady income, or do I need something with a bit more fast growth and a bit more excitement? So that's for you to decide. So some examples of companies that pay you a decent dividend: Imperial Brands, and they pay at least a 14% dividend yield. BP is another incredible company that pays a dividend, and it's around a 9% yield. Standard Life Aberdeen, around an 8% yield. BAT, British American Tobacco, they pay a dividend, and that's around an 8.3% yield. Legal & General, another incredible company that pays a dividend, and they pay a 7% yield. Now, of course, there are some benefits and disadvantages to investing in a company that pays a dividend, because if the company doesn't perform too well, the directors or the board of directors might decide that this year there is not going to be a dividend, there is not going to be a payout. So you might miss the payment, there might not be a payout. So if you factor that money as part of your portfolio growth, it might not happen. But on the flip side, you've got to consider that for a company that pays a dividend regularly, it gives the indication that they are a strong, stable, steady company. So keep an eye out for any of your investments when the company fails or proposes that they will not be paying a dividend. Keep an eye out. That's a tool, that's a tip, that's a trick to ensure that you are in the right place at the right time. Number 2, blue chip stocks. Now, these tend to be very formidable, strong, stable companies. And these are going to be probably household name companies that you're probably aware of. These companies are usually, let's say, high leaders, market leaders in their industry. They're known brands, known names. So you're kind of safe with them because they are household names and brands. Typically been in the market for quite some time. High market cap, usually in the billions and billions of pounds or dollars. So some examples of some blue chip companies will be people like 3M, Amazon, Apple, Coca-Cola, Facebook, Microsoft, Visa. Essentially, a blue chip stock is top 100 companies on the stock exchange. One of the benefits of investing in a blue chip stock is usually these companies are highly diversified. They pay a decent dividend in many cases, and they're pretty consistent on their returns. Okay, so another option for you would be tech stock. Prime example of some tech stock that also fall into other brackets as well would be people like Amazon, Microsoft, Intel, Netflix is an incredible tech stock. Google, also known as Alphabet, Facebook, these are all massive tech stock. So you can see the allure, you can see the let's say the attraction as to why people choose this specific segment to invest in. And people like myself are heavily involved in the tech space. And again, I can do a video another time with regards to why I focus heavily on tech. Just bear in mind some of the companies I've mentioned earlier on. These are all companies that have typically revolutionized the way we do things with regard to technology. And many of them are going the distance. I want you to also consider why the tech space is doing incredibly well. We're in a global pandemic, but you also look at the figures and the numbers of most of these tech companies. In fact, let me read out some of them again. And I want you to just do a little mind check in your mind, or maybe write in the comment section what comes to your mind when you think about some of these tech stock and the global pandemic. Amazon, how did they fare during this pandemic? Microsoft, how have they fared during the pandemic? Facebook, how have they fared during this pandemic? Netflix, how have they fared during this pandemic? Google, how have they fared during this pandemic? So you've got to start looking at these tiny little patterns and tiny little things and saying, are these products and these services and these tech companies rather pandemic proof, rather recession proof, that things that appeal to psychological behaviors? Netflix, psychological behavior. Facebook, psychological behavior. Amazon, psychological behavior. These kind of things play a major part as to why you should consider the tech market or the tech stock as your go-to investment proposition. So another one is what we call speculative stock. Now, this really depends on your appetite for risk. High risk, we don't know what's going to happen. You don't know what's going to happen. In fact, the company probably doesn't know what's going to happen. They don't tend to have any earnings. They maybe don't have the full product developed yet. You could look at things such as the AIM market and the plus market. These are the lower markets or the smaller cap markets. So not lower markets, smaller cap markets. Many a times they might be referred to as penny stocks. Now again, you've got to understand these are highly risky investments. They're very, very risky because essentially there is no fundamental backing. There is no underguard. It's a high level gamble based on a company that's shown a bit of prospect, but there's no credible result yet. But you've read and you've done your analysis and you feel confident with the underlying factors of that business. And you say, I think this has the legs to go the long way. I've been involved in quite a few penny stocks. Now I've shed a few tears sometimes and I've made some money sometimes because they have the propensity to go up or they have the propensity to go really far down. So you've got to weigh up what's your level of risk. That forms part of the strategy. Most of these, let's say, penny stocks or speculative investments, they tend to have some sort of, let's say, new idea, new innovation. Maybe they built an aeroplane that flies at whatever, or they built these pair of trainers that can help you fly. Just something also gimmicky and something also crazy, and they could be the next big thing. So typically, it doesn't require a lot of funds to make a lot of money from a speculative stock if that speculative stock does really well. And lastly, you could look at what we call growth stock. Growth stock are, businesses that don't tend to pay a dividend. They never pay out a dividend. Essentially, they make a lot of money. They make a ton of money, in fact, billions and billions. What they decide to do is to reinvest it back into the company. So of course it favors the shareholders, but you don't get a dividend return from it, or you don't get a dividend from it. Or the only problem that I've ever had with regards to high-level growth stock is because they're so geared on profit in terms of we're going to take our money that we make, we're going to reinvest it back into the business to build this product or to build this function of our business or to empower this and to do this. The only problem that they face is there's high level of scrutiny, which means they don't get a lot of opportunities. Simply meaning, if you're expecting this company to perform really well and they don't perform really well, investors are typically not very forgiving. It's, hey, You promised that you were going to return X amount of money, or you promised that you were going to increase shares by X amount, and you failed to do so. We're taking our funds out and we're investing elsewhere. So I'm going to give you some examples of some growth stocks. An incredible growth stock that will also fall under the tech market. Now, you've got to realize that a lot of them are slightly conjoined, which means they fall into different brackets, but you can kind of understand the overlay of many of them. Dropbox is an incredible growth stock, which also falls into the tech space. Amazon's another one. PayPal is another one. Adobe is another one. DocuSign is another one. As we round up the video, guys, one thing that you do want to pay a little bit of attention to is analyst opinions. So there are people who are full-time analysts, and their job is to analyze the markets and analyze individual companies, especially within their specific industry. And these analysts tend to have a strong say on the direction in which a stock moves or whether people buy them. So you want to at least analyze what some analysts are saying. And typically what an analyst might say is, I recommend, or I put a strong buy on this specific company, I put a hold on this company, I put a sell on this company. So essentially what they're doing is they're doing their deep analysis, and they're saying, based on all the information that we have, based on our technical analysis, based on our research, we suggest that people buy this specific stock, or we suggest people hold on to this specific stock, or we suggest people sell. So you want to be looking at what analysts are also saying and what their predictions are. Hey guys, hope you're doing amazing. TJ here. If you have a 10-year-old to 21-year-old that you want them to become financially savvy, I have a training program just for them. If you click on the link below, sign them up to the training program and teach your kids how to become financially savvy. I'll catch you soon. I hope that really helps you to make a bit more of an informed decision as to where and what direction to look at when you are investing in the stock market.